only 2 days, well, today's day 3, I don't have the numbers yet, but 2 days into the December delivery month, and there's already been 23,970 gold contracts that have stood for delivery. That's 2.397 million ounces, and plus 8,305 silver contracts, or 41,525,000 troy ounces issued and stopped so far, and the month has just started. It's also relevant to note that in November, which I would say was not normal, the silver deliveries ended the month at just under 20 million ounces, about 19.7 million, which it's really crazy because November is not a scheduled delivery month for either silver or gold. There was 1,267,000 ounces of gold delivered. Issued and stopped is the correct terminology. But, the first day, this month, the December contract, Day 1, we saw 7,330 contracts stand for delivery in silver, which is 36, almost 37 million. That's more than $2 billion worth. And although it's not a record, it's close to it. April was the biggest record of just under 12,000 contracts. But to see a 2-day, that's day 1 and 2-day obviously added more, but it's just insanity. There's already been 2.4 million ounces of gold and almost 42 million ounces of silver delivered in 2 days. This is the same type of volume that we've seen all year long. And, it's funny, you and I started talking about this in 2020 before anyone did. And now it's just mainstream mainstream in our business. And I think this will continue until it doesn't, meaning until stuff is just depleted and it's becoming more and more obvious that this is an imminent deal. At the same time, you have one of, if not the largest short position in COMEX futures market, along with a massive short position in SLV, one of the largest ever. And at the time, you have the LBMA, which is running on fumes. And, it's a situation where the delivery via mechanisms are breaking down. Almost 90 million ounces have been delivered off of COMEX since October, since October 1st, 90 million. It's accelerating at a level that I don't think people understand or take for granted. And I think the way that you break that up is just to simply say that, let's make an analogy, right? For years, everyone pretended that, let's call it a cardboard box was full of cookies. There's a picture of a cookie on the outside. And the thing of it, and they would trade that. But now everyone is saying, no, I want the cookies. And people are realizing that the box is pretty much empty. And when that happens, this pretend cookie game, which you could call the derivatives, falls apart. And real cookies, gold and silver, become much more valuable. And that's why prices are rising. And why the dollar and other currencies may look weak when the truth comes out. So yeah, I think it's a big deal. There was a report that JP Morgan shifted its offices to Asia in the middle of the night, that they were told that the people had like 5 days to move their family and everything to Singapore. I believe that is false. So everything that I'm reading tells me that that's not true. I guess we'll find out and we will see, but I know a lot of people have been asking about that. The bottom line, then again, to me, is that the market runs on trust. And when you believe that you'll get delivery of what you were promised, and that trust has been built up over decades, then the system works. And you buy a contract, you can stand for delivery. The metal's there. That's why COMEX has set the price of gold and silver forever. And the analogy is like a bridge that handles a whole bunch of weight until it doesn't, like the 35W bridge in Minnesota that collapsed that I drove over 5 million times. And you're seeing that in London. You're seeing that in the COMEX now. And I don't know. I think that this is going to be a story that gains a lot of traction over the coming weeks and months. I think that the price of silver is just beginning. I really, truly, truly do. And that nonsense of a outage, a glitch and an outage of air conditioning at the CME, a cooling failure, is a bunch of crap, because the metals markets went down. The other CME markets like the bonds and the FX and the repo and the equity futures, well, they stayed online. It was a technical failure isolated to only one asset class and low volume that day, yet the whole thing went down. To me, it just is telling you that things are breaking. And I don't know. I think that this is just the beginning. We saw 12.5 million ounces were transferred out of the COMEX registered category on November 26th. So, where's it going? Who's buying it? How caught are they? These are the things that I would be focusing on right now. To me, that's the most important thing to talk about today.
Your comment about the COMEX reminds me of what happened during the nickel market run-up a couple of years ago. Our mutual friend, our dear departed David Smith, talked to us about that at the time and said, this is a private club. They can change the rules anytime they want. It reminds me of George Carlin's statement that it's a big club and you're not in it. But any comments that you have about the fact that on Friday, when silver was breaking out to a new all-time high monthly close, that's when all this shenanigans seemed to happen, when the trading was halted for 11 hours on the COMEX. Any comments from you about that?
I would just simply say that if a market loses trust in how prices are discovered, or if it can quickly shift the rules, so too will the price discovering. Will shift elsewhere. And to me, all roads lead to the same place, and that's Shanghai, which becomes the price mechanism for physical silver. It will take over for the COMEX. And, when you play these games, we've seen it now in London with the nickel market. We're seeing it here. It's what they did to the Hunt brothers. They changed the rules. They'll raise margin requirements. They'll do all of these things. But when you end up seeing, when you end up seeing a failure of trust, a massive breakdown in trust, I believe that shift will happen. And, it will kind of be like London losing its grip on oil pricing and move to the NYMEX. And, they ran it for a long time. Now they're an afterthought. The same thing will happen here, I believe, that the world will be so angered, if you will, by the fact that this has been a game that has been played for a long time by the West, that it will move to the part of the world that, the center of gravity will move towards Asia, I guess is what I'm trying to say. So yeah, I think that's going to happen. I don't know when, but ultimately, in a world of probabilities, I'd put a high level of certainty on that at some point, it just moves to the part of the world that is cash and carry instead of promises and rehypothecation. In other words, you buy in Asia, you pay your money, you get your bars, and out you go. And before you buy it, you have to buy a bar from one of the pre-approved refineries, and they laser etch the number of the contract that you have on that bar. There is no shenanigans there. It's all about shenanigans here in the West.
Let me start by saying something that almost nobody in the mainstream financial world seems to understand. The physical market is speaking louder right now than at any time in my entire career. You can ignore the talking heads on CNBC. You can ignore the technical traders who think price action is something dictated by a line on a screen. But you cannot ignore what's happening on the COMEX in real terms. And what's happening is simple. People want the metal, not the promise. They want the cookies, not the empty cardboard box with a picture of a cookie printed on the front. And the numbers prove it. We're only 2 days into the December delivery cycle. Today is day 3. And already 23,970 gold contracts have stood for delivery. That's 2.397 million ounces of gold physically demanded. And silver, 8,305 contracts representing 41.5 million ounces in just the first 2 days. That's the kind of volume we saw during the initial silver squeeze. Except now it's not Reddit traders doing it. These are serious players, sovereign-level buyers, possibly industrial giants, hedge funds, sovereign wealth funds. People who don't take delivery just to flex online. They take delivery because they want the metal off the exchange and in their own vaults. And let me remind everyone, December is a scheduled delivery month, but November is not. And yet in November, which is supposed to be a sleepy, uneventful month, we saw nearly 20 million ounces of silver delivered and 1.26 million ounces of gold. That's not normal. That's not seasonal flow. That's structural demand. And if you zoom out a little further, the picture gets almost surreal. Since October 1st, nearly 90 million ounces of silver have moved off the COMEX. 90 million. That is not a market functioning normally. That is a market being drained. And the more it drains, the easier it is for someone to break it. And this is where the problem lies. The COMEX, the LBMA, the entire Western exchange architecture is built not on metal, but on trust. Trust that if you buy a contract, you can get the metal. Trust that the people selling you that contract actually have the ability to source it. Trust that the system is liquid enough to handle stress. Trust that if things get tight, the authorities will manage it. But trust is not infinite. Trust is fragile. And when you start seeing delivery volumes like this, when you start seeing positions being stood for rather than rolled, when you start seeing more metal being demanded than is being replaced, trust starts cracking. And once it cracks, it doesn't come back easily. And let me be very clear, the big problem is not just the unprecedented delivery demand. The bigger problem is that this is happening alongside one of the largest concentrated short positions in the history of the silver market. You've got a massive paper short on the COMEX, a huge short position in SLV, and a London market, the LBMA, running on fumes. The combination of those three realities, large delivery demands, weakening inventories, and massive short exposure, is exactly how financial accidents happen. People forget that, but I don't. I didn't forget what happened in nickel. I didn't forget when the LME blew up the nickel shorts, reversed trades, changed margin rules, and basically told the world, sorry, your profits don't count. I didn't forget when the Hunt brothers were crushed in 1980 by rule changes designed specifically to destroy them. These markets aren't neutral referees, they're private clubs. George Carlin said it best, it's a big club and you ain't in it. And speaking of big clubs, let me address something that's been circulating online recently. The rumor that JP Morgan was suddenly told to relocate its top brass from New York to Singapore within 5 days. People ask me nonstop about it. And look, I'm not going to sensationalize something if I don't believe it. Everything I've researched tells me it's false. It's not happening. Not like that. But the fact that such a rumor even sounds plausible to people should scare you. It shows how little faith remains in Western financial leadership. When people are willing to believe that the largest U.S. bank is evacuating its headquarters under financial duress, you know the facade is cracking.
The technical analysis would say you take the cup and handle when it breaks through the handle, which it has at over $50, that you take the top of the cup in 1980, which was 50, the bottom of the cup, which was $4 in the 90s, and the difference is 46. You add it to the top, and that would say $96 would be the next technical resistance level, if any, or that would be the projected next place to go. And if you take a 42-to-1 ratio right now, or even call it 45-to-1, where it's averaged for the last 100 years, the silver to gold ratio, even though it's been coming out of the ground for 5,000 years, it's 16-to-1, and now it's 7-to-1, meaning it's depleting in nature. The price ratio, largely because of, in the Western world, gold's role as a monetary metal and silver's role in industry, it's average about 45-to-1. So you take gold today at 42.40 and divide by 45, and what do you get? 42.40 divided by 45 is $95. Well, isn't that interesting? That would be where it would tell you to go, where you take the top minus the bottom, which is 46, add it to the top, that would say $96. So, I mean, if you were to see silver at the end of the year at $96, it would not be crazy at all. And if you take 42.40 and divide by 7, it's going to be somewhere around $600. 605. As insane as that sounds, that would match the geologic footprint right now. So yeah, I think silver is the asset of a generation. And I want to always hammer it home. I'm not telling people to buy it to become wealthy. It is wealth. And the biggest money in the world is showing you that. The sovereign wealth funds and the central banks, who have now largely reclassified silver a critical mineral. The US government has, the EU did it in 2023, China did it, and they are restricting exports. And China, as we've said ad nauseum on your show, the second largest producer in the world, is flying to Peru and Mexico and buying doré and concentrate, paying twice what the rest of the world will, and ship it back to refine it. If they're the second largest producer, then why the hell are they doing that? Because it's worth far more than the currency used to buy it. The prices are wrong. they've never been allowed to reach full price discovery when you have the largest concentrated commodity, concentrated short position of any commodity of the 1,000 plus traded on COMEX for years. It just speaks to the why. Why would it be the largest short position in this tiny little commodity? It's not for these banks to make money, is it? Sure, they do, but is there something bigger behind it? And we've talked about that forever. So yeah, what we're witnessing right now is the inability of the players that have used the Western dominance, which is big checkbooks, big pockets of cash, to continue to suppress the price naked. It's now an existential threat. And you're seeing that. The rumor is the reason they stopped is there's one big trader who took possession and would not roll it over a stamp for cash delivery, perhaps an Asian trader who wanted over 400 million ounces of silver. Give it to me. And so, all of a sudden, the cooling breaks down over Thanksgiving in one of the most thinly traded markets of all. So there's virtually no activity, but just those servers broke down. Right. So the point of it is that this signals, just like the LBMA said, sorry, it's not L plus or T plus 1, it's T plus 8 weeks. Right. We don't have enough manpower or trucks. The Western system is crumbling under their own narrative, and they are losing trust. And that ain't good when a system is completely built on trust.
The part that people still don't fully grasp, and I don't say this lightly, is that the breakdown we're witnessing in the physical markets is not occurring in a vacuum. It's happening alongside a historic repositioning by some of the wealthiest, smartest, and most well-connected investors in the world. And I'm not talking about Twitter analysts or newsletter writers. I'm talking about the people who pull the levers behind the curtain. Look around. Warren Buffett sitting on $500 billion in cash, the largest cash hoard he's ever held. Bezos unloading billions in Amazon stock. Nvidia insiders quietly selling while retail is pouring in like it's the second coming of 1999. Retail margin debt at record highs. Retail options exposure at record highs. Retail stock ownership at record highs. Retail is all in, again. And at the same time, the insiders are quietly walking toward the exit with their pockets full and their shoulders shrugged. It's the old Wall Street playbook. When the public is euphoric, the professionals distribute. They don't ring a bell. They whisper to each other in boardrooms and private jets, and they exit stage left while the band is still playing. But here's the twist. A twist that makes this moment unlike any other in modern financial history. The very people who manage trillions, the CIOs, the macro desks, the sovereign allocators, are saying something I have never heard in 35 years in this industry. They're telling institutions to buy gold. That alone is historic, but the allocations they're recommending, that's where the shock comes in. Morgan Stanley says, sell half your bonds and put 20% into gold. 20%. The typical institutional allocation used to be 2%. Maybe 5% if the CIO was feeling rebellious. Now they're telling pension funds, endowments, foundations, sovereign wealth managers, gold is your ballast, gold is your insurance, gold is your hedge, gold is your anchor. Bank of America's Michael Hartnett says, go 25% gold. 25% is not an allocation, it's a revolution. Jeffrey Gundlach, the bond king, says a 25% gold position is not overweight. Not overweight. When the bond king says his own asset class is no longer reliable enough to justify dominance in a portfolio, you know the bond market is sending up flares. These men aren't speaking to YouTube investors. They're not speaking to the guy buying 5 ounces of silver a month. They're speaking to the people who can buy 200,000 ounces of gold with one phone call and not blink. They're speaking to the sovereign funds who buy in 5-ton increments. They're speaking to the mysterious entities standing for massive COMEX deliveries. And that's why, even though retail is still blind, flows at the top are staggering. Our average order size has climbed dramatically. More 6-figure orders, more 7-figure orders. More clients saying the same thing, Andy, I need to move out of cash and financial assets before the reset begins. But here's the irony of ironies. Retail, the mom and pop investor, is asleep. Again. The very people who should be preparing the most are doing the least. They think the market always comes back. They think the Fed always has their back. They think everything will be fine because it always has been. They don't see that the people with the access, the intelligence, the connections, the ones who get the memos before they hit the news wires, are sprinting into commodities, into land, into metal, into hard assets. And the reason is simple. The system is losing trust from the inside out. Look at what the Fed just did. Quietly, discreetly, without a press conference. Over a 5-day stretch, while everyone was distracted by inflation headlines and interest rate chatter, the Fed injected $125 billion into the repo market. This is not normal. This is not seasonal liquidity. This is not routine stabilization. This is crisis behavior. The last time we saw injections like this, Lehman Brothers was collapsing, and in 2019, when repo blew out, overnight lending rates spiked above 10%, and the Fed scrambled to prevent a domino effect. Those events weren't small, they were flashing red crises. And now here we are again. But this time is different, and that's not just a cliche. In 2008 and 2019, the Fed stepped in because banks didn't have enough liquidity. They were insolvent or close to it. They needed cash. Now the banks are loaded with cash. That's not the problem. The problem is structural stress, counterparty fear. In a $13 trillion collateral ecosystem where treasury bonds serve as the foundation of everything, something beneath the surface is breaking, something big. And you know how you know it's serious? Because the Fed is panicking in the shadows, injecting liquidity into the pipes while publicly pretending nothing is wrong. But let's step back and zoom even wider, because the crisis isn't just financial, it's geopolitical. The world's trust in the dollar system is fading, at the same pace that its trust in physical assets is rising. China is restricting silver exports and expanding strategic reserves. The EU has reclassified silver as a critical mineral. The US has reclassified it as critical. South Korea and Turkey are openly accumulating. Russia is building reserves at a speed that would have been unthinkable 10 years ago. China is flying around South America buying Dora and concentrate at double the global price. They are not buying refined bars. They are buying dirty metal before it even becomes silver or gold internationally. That's how urgently they want it. And while they buy, they refine it themselves, strengthening internal capacity while weakening Western refiners. Meanwhile, they're building deep water ports in Peru, expanding Belt and Road logistics, and quietly constructing the supply chain that will dominate global commodities for the next 50 years. The US and Europe are scrambling to catch up. Too late, too slow, too divided. The irony is painful. China, the largest producer of silver outside of Mexico, is not selling into this price rise. They're hoarding, accumulating, restricting, prioritizing domestic use. And worst of all, the West's attempt to suppress silver through decades of paper games, the largest concentrated short position of any commodity on the COMEX, is now backfiring. A paper tail cannot wag a physical dog forever. Eventually, the dog bites. And you're seeing the bite in real time through the delivery figures, the LBMA delays, the inability to source product, the outrageous EFP, exchange for physical conversions, and the widening bid-ask spreads in wholesale markets. People ask me all the time, Andy, when does the system fail? My answer is always the same. The system fails slowly at first, then all at once. We are in the slow phase now, but the slope is steepening. The LBMA itself admitted delays. Not T plus 2, not T plus 5, not T plus 10. 8 weeks. 8 weeks for physical settlement in one of the world's biggest bullion markets. That is not a delay. That is a distress signal. The COMEX outage on the day silver broke out was not a coincidence. These aren't coincidences. They are symptoms of an ecosystem stretched past the point of elasticity. Let me tell you what happens next. As confidence breaks in Western price discovery, the world shifts east. Shanghai becomes the benchmark. Cash and carry replaces hypothecate and pray. No more naked shorts, no more phantom ounces, no more vaporized bids, no more last-minute rule changes. When you buy metal in Shanghai, you receive metal. It is serialized, it is allocated, and it is yours. Period. That is where the world is heading because the world is tired of promises. The dollar's credibility is tied to its ability to deliver. And right now, delivery systems are breaking. And here's the part I want every viewer to understand deeply. You will not have months to react once the break happens. You will have minutes. Because when the first major Western institution fails to deliver, when the first LBMA vault is revealed to be fractionally reserved, when the first Western bank tries to settle in cash because they can't source bars, the trust collapse will be instantaneous. And silver, the most suppressed monetary metal in modern history, will go bidless on every dip. Not offerless, bidless. Every correction will be bought immediately, violently, by the same massive players draining the COMEX today.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.